Javier, my local CPA, said that I need to make an S-Corp election. That's the way to go to save on taxes. Hello there. My name is Javier Correa. I'm the tax director here at the Rothbard Group, and I'm a licensed enrolled agent in the United States of America, fully admitted to practice before the Internal Revenue Service. I can't tell you how many times the American clients of the Rothbard Group have come to us with that sentence from their local CPA. They tell me I'm making $60,000, $80,000, $90,000 a year. The time to make the S-Corp election has come, as if there's an actual time to do it, as if everyone has to do it when they make a certain amount of money. And hey, listen, I'm not pointing fingers, I'm not blaming anyone, but the fact of the matter is a lot of our American clients are used to having very local tax advisors. A lot of my colleagues who are enrolled agents or CPAs in the United States of America have been trained to think locally, whereas here at the Rothbard Group, we think globally, and that makes a huge difference when it comes to international as well as multi-jurisdictional tax planning. So your local CPA potentially isn't wrong, but he's not taking international and global growth elements into consideration the way we would here at the Rothbard Group. So what is my intention today here with this video? My intention is not to tell you don't make an S-Corp election, but my intention is to help you understand what are the consequences of making an S-Corp election and empowering you to understand when an S-Corp election is truly strategic and when is your local CPA just pushing you into that election just because it's something that is trending and something that simply everyone does in the United States. So let's start by explaining what an S-Corp election is. Let's say you have a business in the United States of America and you're a U.S. person for tax purposes, meaning that you are a U.S. citizen, a green card holder, or somebody who lives full-time in the U.S. and meets U.S. tax residence criteria under the substantial presence test. Now, in many cases, you're going to run your business through either a limited liability company, an LLC, or you're going to run your business through a corporation, like a proper traditional corporation. I'd say LLC is more common, but I still see a couple of people who are out there who say, I'd prefer the traditional old school corporation. Now, in either of those cases, you can make an S-Corp election. An S-Corp election is essentially a decision that you're making by telling the IRS that you want to be treated as an S-corporation for tax purposes. So this is a tax election, not an entity per se that you're forming at the state level. Again, either an LLC or a corporation can be taxed as an S-Corp if you decide to make that election. Now, once we get out of the way, let's talk about what the exact benefit of an S-corporation is and why so many local CPAs in the United States actually push it forward, even though it may not be the most strategic decision in every single case. S-corporations were essentially designed to be the ideal vehicle for small local businesses in the United States of America. They were designed to provide some relief to small businesses when it comes to self-employment taxes. So keep in mind that if you're an American and you are conducting an active trader business, right, you are likely subject to both income tax at the federal level as well as self-employment taxes. And if you live in a high tax state like California or New York, you're probably also subject to state income taxes. Now, to keep this analysis simple, I'm going to be concentrating on federal income taxes and federal self-employment taxes, just to keep things easy and digestible. If you're running your business as a traditional single-member LLC, for example, you are going to be subject to federal income taxes as well as self-employment taxes on the same income your business is generating. That income, if you're a single-member LLC that is disregarded for U.S. tax purposes, is most likely flowing down to that Schedule C of your 1040 tax return every single year. If you're a partner in a partnership or a multi-member LLC taxed as a partnership, then you are also likely subject to self-employment tax on the amounts of money that are allocated to you on those K-1s every single year, as long as you are a partner that is participating in the business, that is actively engaged in the business, that has management power over the business. And again, same scenario arises. You are going to be subject to both federal income tax and federal self-employment tax. Now, the S-corporation election comes in and says, I will provide relief. I will allow you to claim a reasonable salary, which will be subject to self-employment tax, but then the rest of the income, I'll allow you to keep that as only subject to income tax as a kind of capital distribution from the business. And so if you look at that on paper, you say, well, that's fantastic. I can save that 15.3% self-employment tax on a significant portion of my business. That sounds great. Perfect. Let's do it. But what most local CPAs in downtown Houston or Little Rock, Arkansas fail to tell their clients is that the S-corporation election comes with a lot of limitations that would not, I would say, be ideal for the global-minded entrepreneur. They may not bother the very local mom-and-pop shop in the US, but for entrepreneurs like the ones we work with here at the Rothbard Group, entrepreneurs without borders, entrepreneurs that want to conquer the world and want to invest internationally, the S-corporation does pose some significant barriers. So let's take a look at those one by one. Number one, and most importantly, the S-corporation does not allow for foreign ownership, meaning that if you have a business that has made an S-Corp election and you happen to find that ideal investor, that investor that is willing to put capital into the business, who believes in your project, that investor who wants to take you international, but unfortunately that investor is foreign. He is a non-resident alien. He is not a US person. And I tell you, in this increasingly digital global economy, it's becoming more and more common to see Americans team up with Canadians and British nationals and Australians to form global businesses. So if your business is structured as an S-corporation, that non-resident alien investor, he's simply unable to put money into your business because it's black and white. If you're not a US person, you can't be the co-owner of an entity that has made an S-Corp election. It's as simple as that. No foreign capital. So that's limitation number one that we always mention to our clients here at the Rothbard Group. Limitation number two, if you have an S-corporation, you can't be creative with corporate governance. Let me say that again. You cannot be creative with corporate governance, meaning that, let's say you're thinking about bringing on those investors and you're saying, okay, I'd like to create some management shares. There are some jurisdictions that allow that, shares with only management. You know, I'd like to be creative in the way I organize my ownership because at the end of the day, you know, I want to make sure that I, as the founder of the company, retain certain rights. I want to make sure that early investors get certain rights and other later investors maybe get other benefits, but maybe not the same ones as the early ones. Well, if you have an S-corporation, all that is out the window. If you make an S-Corp election, then essentially everyone has to get the same rights. You get one class of stock. That's it. No management shares, no Class A and Class B shares. All that is out the window. And a lot of the corporate governance architecture that we're able to design here at the Rothbard Group, for example, we just cannot apply it if you make an S-Corp election. Number three, S-corporations are limited to 100 shareholders or owners of the business. Now, this may seem like something that wouldn't affect you necessarily directly because, let's face it, having 100 co-owners in a business means you're pretty large. But we have had cases where that has become an issue. I mean, when businesses grow and scale, hitting that 100 number is not as difficult as you may think it is. So having that limitation, even if it's not the most immediate limitation, does bother us here at the Rothbard Group, and is something that would discourage us from recommending the S-corporation election as strategic in most cases. Number four, if your business relies on access to credit because you need debt financing to purchase assets like real estate or equipment, then an S-corporation might not be ideal. Now, this refers to the topic of basis in an S-corporation. Basis is a very complex topic in the US. You have, for example, for partnerships, you have outside basis, inside basis. For S-corporations, you also have this notion, but it is much more limited in the sense where if you rely on debt, you can't really get debt basis in an S-corporation unless you yourself, as the owner of the business, are actually lending money to your own company. Unlike in a partnership where you can get basis for the liabilities incurred by the partnership to purchase these assets. Now, this is getting very technical, this topic in particular of basis, but what I want you to retain in your memory is that S-corporations give you far less flexibility if your business requires credit, loans, and debt in order to finance certain asset-heavy projects. So all of that is also a serious limitation that you have to take into consideration. And then number five, in addition to not allowing non-US ownership of the business, S-corporations also have a lot of limitations in terms of which US persons can even be owners or co-owners of an S-corporation. So you also have to keep that in mind. You have to essentially make sure that all of your partners are compliant with who can and cannot be essentially co-owner of an S-corporation. Now, as you can see, these limitations are not ideal for the person that is running a global business, the person that is looking to raise capital, and in particular, the person that is looking to raise capital from foreign investors. There are just too many rules, too many limitations, and it is simply not ideal. Does a potential savings from a self-employment tax perspective really compensate these things? I don't think so, not in the majority of cases. And on top of that, let me add another element, which is food for thought here. When we talk about an S corporation, we're talking about granting yourself or giving yourself a reasonable salary. Many people take this term reasonable and they say, well, Javier, I mean, if I get to say what a reasonable salary is, I'll just say, hey, listen, my business made $1 million. My reasonable salary is $10,000. Therefore, I get $999,000 with no self-employment tax. Isn't that great, Javier? I can just say a reasonable salary is $10,000. Well, guess again, the market gets to decide what a reasonable salary is. And if the IRS takes a look at those tax returns and sees this and says, this doesn't make sense, the IRS is going to come in and say, hey, we do not agree with this. You are a, let's say, lawyer, accountant, architect, whatever. The fair market rate for this is this based on comparable professionals that are doing the same work. Therefore, we are increasing your salary to this, and now you owe us self-employment tax on this amount of money that you failed to properly classify. So it's not as easy as saying I can just determine whatever amount seems fair to me as an individual. You have to take into consideration that it's the amount that the market has determined as fair for the services you're providing to your own company. And I don't know too many people out there that actually put in the time and effort to determine what a comparable third-party professional doing the same work would charge their companies if they had to pay a third party to perform their duties within the firm. So all of this takes time, it takes effort, it takes money, and it's simply a lot of work simply to save 13.3% in self-employment taxes, which is why here at the Rothbard Group, we integrate international strategies for U.S. persons so we can leverage foreign entities. Even though we are aware of all the difficulties that arise from that as well, we are fully aware of Subpart F, we are aware of GILTI, which is now net CFC tested income. We're fully aware of the complexities involved in international tax planning, but we are also aware of all of the advantages that come with international tax planning and how in the vast majority of cases in today's digital economy, they outweigh the advantages that come with pure local planning like a simple S-Corp election. Now, with that being said, do I believe and does the Rothbard Group believe that there is absolutely no room for S corporations whatsoever in general tax planning? No, I believe you can never truly say that something is completely useless from a tax perspective. Everything has to be based on individual facts and circumstances. In fact, if you're just a local American running a local business somewhere in the U.S., you're only dealing with U.S. customers, you're not planning to scale globally, you're not planning to raise capital, you don't need to borrow money from the bank to buy equipment or real estate or anything like that. It's just you and your business and you're providing a service and you're 100% U.S. focused, then sure, maybe the local CPA can help you out and that S corporation definitely could potentially make sense for you. But if you want to take it to the other level, if you want to take it to an international scale, a global scale, then definitely the S corporation brings, I would say, more limitations than it does advantages. So if you're in that category of Americans that are planning aggressive expansion, if you want to grow beyond U.S. borders, if you want to take on the world and become a global corporate giant, and you're ready to move to the next level, Rothbardgroup.com. We look forward to working with you. And this was Javier Correa, Tax Director for the Rothbard Group.